You are standing at a public printer inside a county courthouse self-help center. The machine costs 25 cents a page. On the wall beside it, laminated in cloudy plastic, is a fee schedule from a Payday lender 2 blocks away. You read it the way you might read a menu in a language you almost speak. The numbers are there. The math is not explained. That is the first thing to understand about borrowing money. The price is always posted somewhere. It is almost never translated. Borrowing is not one product. It is a ladder. Every rung has a different cost, a different requirement, and a different idea of who the lender thinks you are. The higher you climb, the cheaper the money gets. That is not a coincidence. That is the mechanism. Here is every level. Level 1, payday loans and check cashing advances. The laminated notice says, fee of $17 per $100 borrowed, due in 14 days. You borrow $300. You owe $351 in 2 weeks. The $51 fee sounds manageable until you annualize it. Roughly 442% APR. That is not a typo. That is the legal, disclosed cost of borrowing $300 for 14 days. Now suppose the $351 is not there on payday. You roll the loan over. Another $51. And again, after 10 2-week cycles, about 5 months, you have paid roughly $510 in fees on the original $300. The principal has not moved. You have paid more in fees than you originally borrowed. This is not predatory in the sense of being hidden. It is predatory in the sense of being designed for a borrower who has no alternative. The lender knows the rollover rate. The rollover is the product. No credit score required. No collateral. No relationship. The price of that accessibility is the highest interest rate most people will ever pay. Level 2, credit card revolving debt. You are at a municipal utility payment window waiting. You pull a paper credit card statement from your bag. The balance is $2,400. The minimum payment is $48. The APR printed in the lower right box is 28.99%. Pay only the minimum each month, and that balance does not shrink in any meaningful way. Interest accrues faster than the minimum erases it. The balance can persist for years. You can pay hundreds, eventually more than 1,000, in interest before the principal is gone, depending on how much you continue to charge. The credit card is more flexible than a payday loan. You can use it anywhere. Pay it in full every month, and you pay 0 interest. The trap is not the card. The trap is the revolving balance, the minimum payment, and the 28.99% running silently in the background while you pay for groceries and streaming subscriptions on the same piece of plastic. Credit cards also have a feature payday loans do not, a credit score requirement. To get a card with a reasonable limit, you need a history. That history takes time, which means the people who most need cheap credit are often still at level 1 while they build it. Level 3, unsecured personal loans. You are at a public library printer counter. The page coming out is a loan offer from an online lender. The terms are printed clearly. $5,000, 14.9% APR, 36 months. Monthly payment, approximately $173. Total interest over the life of the loan, approximately $1,231. That is a different world from level 1. You are borrowing more, paying less per dollar borrowed, and the payoff date is fixed. You cannot roll it over. To get here, you need a credit score, typically somewhere above 660, though stronger scores unlock better rates. You need income verification. You need a debt-to-income ratio that does not alarm the algorithm. Online lenders have made this tier more accessible than it once was. The application takes minutes. The money arrives in days. The rate range at this level is wide. A borrower with a 780 score might see 10%. A borrower with a 640 might see 22%. Same loan, same lender, same day, different price based entirely on what the lender thinks you will do. This is where the mechanism becomes visible. The loan is not priced on what you need. It is priced on what you represent as a risk. Level 4, asset-backed small loans. You are at home, opening a file box. Inside, a savings account statement, a certificate of deposit, a brokerage confirmation. These are not just records. They are collateral. A share-secured loan, or any small loan backed by a savings account, a CD, or a similar liquid asset, works differently from an unsecured loan. The lender holds your asset as security. In this example, a loan of $8,000 at roughly 9.5% APR over 36 months carries a monthly payment of about $256 and roughly $1,214 in total interest. The lender is not betting on your character. They are holding your money as insurance against your character. There is something almost paradoxical about this. You need savings to borrow cheaply. But if you have savings, why borrow? Sometimes the answer is cash flow. You do not want to liquidate a CD early and pay a penalty. Sometimes it is credit building. Sometimes it is keeping an investment position intact while funding something else. The asset does the talking. The rate reflects that. Level 5, HELOC and home equity borrowing. You are in a title company closing room. Not a bank branch, a closing room. A table, a notary, a stack of documents with tabs. The agent slides the HELOC agreement across. The rate is variable, tied to a benchmark, and in this example sits around 7.2%. A home equity line of credit uses your house as collateral. The lender can lend at a lower rate because if you stop paying, they have a claim on real property. Real property has an address. It can be sold. The HELOC is a line, not a lump sum. You draw what you need when you need it, up to a limit based on your equity. You pay interest only on what you use. The rate floats, which means it can rise if benchmarks rise. Closing costs are real. The timeline to open the line is weeks, not hours. This is also where the loan stops being a consumer product and starts being a financial tool. A HELOC can fund a renovation, bridge a business cash flow gap, or sit as a liquidity reserve that costs nothing until you draw it. The rate is not a penalty. It is a reflection of the collateral quality. To reach this level, you need equity. You need a home. You need a credit history that does not disqualify you. Most people do not reach this level until their 30s or 40s, if at all. Level 6, securities-backed line of credit. You are in a brokerage back-office document review room. Fluorescent light, no windows. The document in front of you is a margin agreement for a securities-backed line of credit, sometimes called an SBLOC. Your portfolio is the collateral. The rate is tied to a benchmark and, in this example, falls in the range of 4% to 6% depending on portfolio size and custody arrangement. You do not sell your investments to raise cash. You borrow against them. The portfolio stays invested. If the market rises, you benefit. If the market falls, the lender may issue a margin call, a demand that you deposit more collateral or repay part of the line immediately. That clause is not a footnote. It is the central risk of this structure. The rate is low because the collateral is liquid. Stocks and bonds can be sold in hours. The lender knows exactly what they are holding and what it is worth every day. At this level, the borrower is typically not short on cash. They are borrowing because selling would trigger taxes, disrupt an investment thesis, or break a position they want to hold. Whether the potential tax benefit outweighs the interest cost depends on your specific situation, your bracket, and how the position is structured, not a general rule. Level 7, private bank lines and internal lending structures. You are in a sparse document review room. One window, 2 chairs, a term sheet on the table. No brochures, no lobby. No one is trying to sell you anything. At this level, the lender is a private bank, a family office, or a trust structure. The rate, in this example, falls in the range of 3% to 5%, sometimes lower, depending on the relationship, the collateral stack, the size of the commitment, and the benchmark environment. None of those terms are fixed. All of them are negotiated. The collateral stack might include a portfolio, real estate, a business interest, a life insurance policy with cash value, or some combination. The relationship matters in a way it does not at level 3. The private bank is not running your application through a scoring model. They are underwriting you as a client, your total balance sheet, your history with the institution, your family's history if relevant. At the furthest edge of this level, inside a family office or a trust structure, the lending can become internal. A trust lends to a beneficiary. A family entity lends to a member. The rate is set by reference to a federal benchmark to satisfy tax rules, not by a lender's margin requirement. The money moves within a structure the family controls. The tax and legal implications of these arrangements are specific to each structure and each family's situation. Anyone operating at this level should have qualified legal and tax counsel involved. This is not a product you apply for. It is an arrangement you are already inside, or you are not. You walk back to the courthouse printer. The laminated notice is still on the wall. $17 per $100. 442% APR. $300 becomes $351 in 2 weeks. Across town, someone with a $2 million portfolio is drawing $300,000 from a securities-backed line at 4.5%. The annual interest on that is $13,500. Per dollar borrowed, they are paying less than 1.5 cents on the dollar each year. The person at the courthouse printer is paying more than $4 on the dollar annually. Same act. Borrowing money. Different price. The price is not set by how much you need the money. It is set by how much collateral you have, how much history you have, and how much the lender stands to lose if you disappear. The more you have, the less it costs to borrow. The less you have, the more it costs. That is not a moral judgment. It is the structure. Understanding the structure is not the same as escaping it immediately, but it tells you what the game actually is. The path from level 1 to level 3 is a credit score and a stable income. The path from level 3 to level 5 is equity in something real. The path from level 5 to level 6 is a portfolio large enough to pledge. Each rung requires the one below it. The laminated notice does not explain any of this. It just posts the fee. Now you know what the fee is for.